Right now, as we stare at the terminal on this Tuesday, December 2nd, the ticker for Hanesbrands Inc. is effectively frozen in amber at exactly 6.47 USD. We are seeing zero intraday movement, a flat line that isn't the result of low volume or investor apathy, but rather the final heartbeat of a corporate entity as we knew it. The market narrative, the expectation, is usually that when a stock stops trading, the story ends. Investors look at that 6.47 price tag, which represents the final closing valuation before the suspension, and they assume it is time to pack up, take the cash, and go home. They see a legacy apparel maker that struggled with debt and shifting fashion trends, finally succumbing to a buyout. The expectation is that Hanesbrands was simply a distressed asset that found a lifeline, but the reality is significantly more profound. What we are witnessing is not just an acquisition, it is a massive consolidation event that fundamentally rewrites the playbook for the global apparel supply chain. The reality is that while the HBI ticker is dark, the capital that was trapped inside it has just been transmuted into a new, far more aggressive form via Gildan Activewear. The 6.47 USD price is not a ceiling. It is the entry point into a new vertical monopoly that is poised to dominate the basics market in a way Hanes never could on its own. To understand why this moment at 6.47 USD is so critical, we have to look at the immediate context of the last 48 hours. Just yesterday, December 1st, Gildan Activewear officially completed its acquisition of Hanesbrands. This is why the price is pinned. The volatility has been stripped away, replaced by the mathematical certainty of the deal terms. Shareholders are looking at a package of cash and stock, specifically $0.80 in cash and 0.102 shares of Gildan for every share of HBI they held. If you are holding Hanesbrands in your portfolio right now, you are in a state of metamorphosis. You are no longer holding a struggling underwear manufacturer, you are effectively holding a derivative of Gildan. This shift is massive. Hanesbrands was a company burdened with debt, struggling to reinvent its champion brand, and fighting a war on multiple fronts. Gildan is a manufacturing machine, a company that wins by being the lowest-cost producer. By merging these two, the market is creating a leviathan. The reality is that the 30% premium we saw leading up to this price was just the appetizer. The main course is the synergy realization that is about to happen. Let's analyze the price action leading up to this freeze. The stock had been hovering in the mid-sixes, battling resistance. The 6.47 USD level represents the market's final consensus on the deal's probability of closing. It traded right up to the line. Now, for investors who use Fidelity or Fidelity Investments to manage their portfolios, you are likely seeing a reorganization fee or a change in CUSIP number in your transaction history. This administrative shuffle hides the strategic brilliance of the move. Hanesbrands had a massive distribution network but an inefficient supply chain. Gildan has a massive supply chain but wanted more brand power. This deal at 6.47 USD effectively solves both problems instantly. It is a rare case where 1 + 1 might actually equal 3, provided the integration doesn't stumble. We need to talk about the Champion brand because it is the ghost in the machine here. Earlier this year, Hanesbrands sold the intellectual property of Champion to Authentic Brands Group for over $1 billion. This was the prelude. The expectation was that selling the crown jewel would leave Hanes hollowed out. Critics said, "What is Hanes without Champion?" The reality was that selling Champion was the only way to clean the balance sheet enough to make this merger possible. It was a surgical amputation to save the patient. The 6.47 USD price reflects a leaner, more focused innerwear business that is now being plugged into Gildan's back end. This is critical for anyone interested in online investing or analyzing sector trends. The fashion risk is gone. Hanes is now purely a basics volume play. I want to pause here and get your take on this merger. Comment below, Are you happy to receive Gildan shares in exchange for your Hanes stock, or would you have preferred an all-cash buyout to just walk away? The sentiment on this is split, and I want to know where you stand. Now let's look at the financials that justified this final valuation. In the third quarter of 2025, reported just a few weeks ago, Hanesbrands posted net sales of $890 million. This was a decrease of about 1%, which feeds the declining business narrative. However, look closer at the margins. Operating profit increased by 14% to $108 million. This is the key. They were selling less but making more on what they sold. This discipline is exactly what attracted Gildan. It shows that management had already started the hard work of cost-cutting before the acquirer even walked through the door. For a user of Schwab Intelligent Portfolios or someone looking for investment help, this is a classic signal of a value unlock in progress. The market was pricing HBI as a dying retailer, but the internal metrics showed a company becoming more efficient. That disconnect is where the deal value was found. We also have to consider the synergy number, $200 million. That is the amount of cost savings Gildan expects to extract from this combination. In the world of interactive brokers trading and high-frequency arbitrage, that number is gold. It means that the 6.47 USD price tag effectively underpriced the future cash flows of the combined entity. If Gildan can actually strip out $200 million in redundant costs, warehousing, logistics, administrative overhead, the earnings accretion will be significant. The Hanes brand doesn't disappear, it just becomes cheaper to produce and distribute. This is the Walmartization of the underwear drawer. Let's discuss the risks, because even though the deal is closed, the risk for shareholders hasn't vanished, it has just transferred to Gildan stock. The integration risk is huge. Merging two massive corporate cultures is messy. Hanesbrands was based in Winston-Salem, with a very specific American corporate heritage. Gildan is a Canadian company with a manufacturing base heavily concentrated in Central America and the Caribbean. If the cultures clash, or if the IT systems don't talk to each other, that $200 million in synergies could evaporate. We have seen this happen in the textile industry before. Also, the debt load of the combined company will be higher. In a high interest rate environment, servicing that debt could eat into free cash flow. This is why some Robinhood stock trading enthusiasts might have bailed out at 6.47 USD rather than holding the new shares. They preferred the certainty of the exit over the uncertainty of the execution. However, the reality remains that Hanesbrands has a stickiness that is hard to replicate. You can switch your search engine. You can switch your car insurance, but people rarely switch their underwear brand once they find one they like. It's a habitual purchase. By controlling the shelf space at Walmart, Target, and Amazon, the combined Gildan-Hanes entity has a defensive moat that is incredibly wide. The SoFi investing crowd often overlooks these boring consumer staple moats in favor of tech, but in a recession or a slowdown, people still buy socks. The 6.47 USD valuation was essentially a floor price for this defensive stability. Let's look at the short squeeze angle that played out in the final months. Hanesbrands had a relatively high short interest leading up to the deal. Skeptics were betting the deal would fall through due to antitrust concerns. The expectation was that the FTC or DOJ would step in and block it, causing the stock to crash back to $4. The reality was that the regulator saw the apparel market as sufficiently fragmented. When it became clear the deal would clear, the shorts had to cover. That buying pressure helped pin the stock at the deal price. Users of the Interactive Brokers platform who track short interest would have seen this capitulation happening in real time. It's a lesson in not betting against consolidation in a mature industry. Now consider the user experience for the average retail investor. If you held Hanesbrands on an app like Robinhood or SoFi Invest, you are now in a limbo period. Your screen might show the $6.47 price, but you can't hit the sell button. This psychological lockup forces you to become a long-term investor in the new entity. It is a forced conversion. For many who were trading Robinhood fractional shares of HBI, this cleanup is automatic, but it changes your exposure. You are now exposed to currency risk, Canadian dollar versus US dollar, and global manufacturing risk in a way you weren't before. It effectively institutionalizes your portfolio. What does the future hold for the Hanes brand under new management? The expectation is that they will slash marketing and focus purely on supply chain. The reality might be different. Gildan has signaled they want to grow the brand, not just milk it. They might use their lower cost basis to lower prices and aggressively take market share from fruit of the loom or